On this week's Money Minutes with Sev, we're tackling a question I get all the time. Should you lease or buy your next vehicle, and should it be new or used? Now, I know what you're thinking. What does a car decision have to do with personal finance? Well, more than most people realize. And by the end of this video, you're going to understand exactly why this decision matters way more than just your monthly payment. Let's start with something important. A lot of Canadians are overburdening themselves with car payments they simply can't afford. Look, most of us need a vehicle to get around. That's just reality. But here's the thing. You don't need a high-end vehicle to get from point A to point B. And when you overspend on a car, it affects your debt ratios. And those debt ratios, they can restrict or even completely negate your ability to get a mortgage or refinance the one you already have. So before you walk into a dealership, you need to understand this. Now, leasing and buying are simply two different ways to finance a vehicle. One finances the use of a vehicle, the other finances the purchase of a vehicle. That distinction sounds simple, but the financial implications are very different. Let me break this down for you. When you buy a vehicle, you're paying for the entire cost of that car, regardless of how many kilometers you put on it. You typically make a down payment, you pay sales tax, and you carry a loan at an interest rate determined by your lender based on your credit history. When you're done, you own the car outright and you can sell it or trade it in for whatever it's worth at that point. When you lease, you're only paying for a portion of the vehicle's cost, specifically the portion you use up while you're driving it. There's often no down payment required. You only pay sales tax on your monthly payments. And instead of an interest rate, there's something called a money factor, which works similarly to loan interest. At the end of your lease, you either hand the keys back or you buy the car at its depreciated value. Here's a quick example to make this concrete. Say you're leasing a $20,000 vehicle that will have an estimated resale value of $13,000 after 24 months. You're only paying for that $7,000 difference, which is called depreciation, plus your finance charges and any applicable fees. That's it. When you buy that same $20,000 car, you're financing the full $20,000 plus finance charges and fees. That's fundamentally why lease payments are significantly lower than loan payments. You're simply financing less of the vehicle's value. Now, every monthly lease payment has two components. First, a depreciation charge. This compensates the leasing company for the portion of the vehicle's value that gets used up while you're driving it. Second, a finance charge. This is essentially interest on the money the leasing company has tied up in the car while it's in your driveway. Loan payments, same idea. You've got a principal charge that pays down the full purchase price and a finance charge that's your loan interest. Here's the part most people miss. A portion of every loan payment you make is also going toward depreciation. That's money you never get back, even when you sell the car down the road. The remainder of your loan payment builds equity, what's left of the vehicle's original value after depreciation has done its damage. And I want to be clear, the longer you drive a vehicle, the less equity it holds. Cars are not investments. They go down in value, full stop. If you find this breakdown helpful, hit that like button. It really does help this channel reach more Canadians who could use this information. So here's where it gets interesting for a lot of people. If you're a disciplined saver or investor, leasing can actually free up monthly cash flow. The difference between a lease payment and a loan payment on the same vehicle, that's real money. And some financial advisors will tell you to put that difference to work somewhere it will actually grow. Think your mortgage, an investment property, or a registered account like a TFSA or RRSP. That's money that goes up in value instead of sitting in a depreciating asset. Now, I want to come back to something I said earlier in the video because this is the part that matters most to my clients as a mortgage broker. Whether you lease or buy, that monthly payment shows up on your credit bureau, and lenders look at your total debt obligations relative to your income, what we call your debt service ratios. A car payment that's too high can push your ratios over the acceptable threshold. That can mean a smaller mortgage, worse terms, or in some cases, no mortgage approval at all. So if you're planning to buy a home, renew your mortgage, or refinance in the near future, I strongly recommend speaking with a mortgage professional before you sign anything at that dealership. Not after, before. Know exactly how much room you have in your ratios before you commit to a payment. The takeaway here is this. Leasing versus buying isn't really about which option is better in the abstract. It's about which option fits your overall financial picture. Lower monthly payments through leasing can be a smart move if you use that extra cash strategically. Buying builds equity over time, but neither one helps you if it blows up your ability to qualify for a mortgage. Knowing the rules and understanding how these decisions connect to each other, well, that's what helps you feel more prepared, more confident, and better positioned to make smart decisions with your money. If you found this helpful, hit that subscribe button and the notification bell so you never miss a new Money Minutes. And send this to someone you know who's about to sign a lease or car loan. This information could save them a real headache down the road. That was your Money Minutes with Seb. Catch you next time.